And I do think that there's a calculation with, say, the stock market or Bitcoin or something like that, that's much more liquid, where they're thinking, well, yeah, it's rising. I want to get in on it. And if it starts to fall, I can just get out, right?
Mhm.
Because they know that they can limit their losses.
Alrighty, folks, the Fed cut 50. The stock market's ripping. Bitcoin is ripping. His commercial real estate is about to rip as well. We're going to have this conversation with Jonathan Twomley. Well, in video number one, Jonathan, you admitted you were shocked by the fact that the Fed chose to go 50. Early indications are saying the stock market loves it. We are seeing risk assets go on. The Nasdaq is ripping. Bitcoin is up $3,000 to 63 and change, I believe, as of recording. What does this mean for real estate, residential, commercial? Are we just back to party time and, dumb money?
No, not yet. And the reason is no, and the reason is, look, real estate is not a liquid asset like those other things are. It's
Yeah.
very hard to take advantage of these market moves, and the market lags a lot. When during or after the great financial crisis, the Fed cut rates to zero very quickly. I mean, if you look at that chart, you see how fast they cut rates to zero. It took 2 more years for the commercial real estate market to bottom out after you hit zero, right? Because there's just a long lag time. Like you said, we've got extend and pretend, we've got we've got equity scared, we've got banks scared, we've got banks repairing their balance sheets. Like, so many things go into the market liquidity in real estate, that when the works get gummed up the way that they have been the last couple of years, it takes a while for them to get, ungummed up again, right? So I don't see, even with rapid cuts, I don't see the commercial real estate market changing that fast. And the reason is just because it's like turning a battleship, right? It is just a slow grind kind of market, and you just won't see it turn around that fast. I think we've had a lot of, there were record transactions in 2022, right? At the absolute top of the market, all those deals, even with pretty substantial rate cuts, a lot of those deals will still be underwater because of two things: their expenses have risen, and their vacancy has also risen, right? And so we've got, what everybody seems to be saying is, just on the vacancy side in a lot of markets, we've got kind of 2 more years until the current pipeline of property is completely done and out of the ground, and you start having, meaningful positive absorption, right? Until you have that kind of absorption, you're not going to have meaningful rent growth, right? Until you have meaningful rent growth, you're not going to have NOI growth. But NOI is down because of these added expenses. So even with interest rates will help, but the problem is, as we showed in the last video, we didn't play around with the NOI that much, but NOI is really just as much of a problem as interest rates.
No
And
question.
so, we've had, and as we've mentioned on the show many times before, the issue hasn't simply been that interest rates went up. It's that interest rates went up and expenses went up and vacancy went up all at the same time. And when you have that trifecta, you really have troubled assets. You have a lot of people who are in a negative equity position, and they're not eager to go and invest in a lot of new deals right now, because they're thinking, well, why am I going to, I think the thinking is wrong, because now's a great time to invest. Much better than it was in 2022, when so many people thought that was a great time to invest. Now is the time to be investing, but that's not how most investors think. Most investors on a retail level, want to invest when it's hot, don't want to invest when it's cool, and they do the exact opposite of what they really ought to be doing. But most most retail investors now are feeling shell shocked, and it's going to be time before they come back. On the institutional side, I think you'll see some more movement at those institutional level properties. But I think for like syndication world, it's going to be a while before we see
I think you're going to need
this return.
brand new crop of investors.
Absolutely. Yeah. You'll need people who have not been burned, right? To kind of like mature into investing in real estate, and people to finish kind of licking their wounds, right? So
one of the things that I am thinking about, there's record amount of money in money market accounts, CDs, things of that nature, right? They always talk about all this dry powder on the sidelines. I think the last number I saw was $6.2 trillion. Well, yesterday the Fed cut rates. Savings rates are already cut this morning. That's how fast it is.
Hmm.
A lot of high interest savings accounts were earning 4, maybe up to 5%, somewhere in there. I'm curious, when does that say? Because again, if you were getting 5% on a savings account, that's, I mean, I'm 52. That's like higher than I can ever remember, right? We've always
Right.
been at near nothing, right? Um, Certainly for multiple decades. I'm curious, how low does savings rates have to go before we go back to, I'm losing to inflation? I got to put this money to work because, again, in an environment where stocks are at all-time high, real estate's at all-time high, commercial real estate's tanking, a lot of people just said, I'm out. I'm just going to stack cash and earn 5%. Well, now it's 4.5. Soon it's going to be 4. Then it'll be 3.5. I'm asking myself, when does that money come off the sidelines?
Yeah, well, I think it obviously the Fed is trying to push the money off the sidelines, right, by lowering interest rates. That's part of that's a big
For
piece of
sure.
this, right? Um, I I mean, look, I'll just go back to where I was a minute ago. There is a there was a 2-year lag in the GFC, right? And I
Yeah.
think in the correction before that as well, but before the commercial real estate market bottomed out. The problem is that you'll see a lot of people just, whatever the reality is, their perception is that values are going to continue to fall, and nobody wants to catch a falling knife, even though frankly, I mean, in the long run, maybe it's not a falling knife at all, right? I mean, if you're already at a 25% correction, what, it's going to correct another 5%. Historically, we know that absent something big,
Yeah.
maybe there's another 5% to go, right?
Sure.
But maybe it's bottomed out. I mean, maybe price wise it's bottomed out, but transaction wise, so it's. I just think that there's going to be because we're dealing with psychology here rather than just
Correct.
raw economic analysis. And maybe though that sort of anybody who's sort of a hot money person, maybe they're going to look and see, oh, Bitcoin is up, I'll jump into that. Oh, the stock
Mhm.
market is up, I'll jump into that, right?
Yeah.
And so getting into something that's illiquid, I think is going to be, again, uh, the retail investors don't jump in until they start seeing other people making money, and so it can be a long time before you see that happen. I mean, in the last cycle, the bottom of the market was 2012. When you really saw people rushing into the market was 2016 on a
Yeah.
retail basis, right? So,
Yeah.
and that was because they'd seen that early money start making money already. So maybe
Yeah. The
it'll
next,
be a little bit compressed this time, but I just don't see this like suddenly turning around just because the Fed cuts. And even if the Fed cuts next, if the Fed continues to cut, like you, what message does that send too? Is it sending the message that like the economy's in trouble, in which case people are like hunkering down? Like
yeah.
I just don't.
I don't know if you
I
know
think
this,
the
but this is only the third time that they started the rate cutting cycle with a 50.
yeah,
And
you
the
mentioned
last
that.
time was
Yeah,
the GFC.
yeah. So when was the time before?
I think it was the dot-com crisis, but I haven't validated that, but I need to
Right.
go back and look. Yeah, it's very interesting. The again, what I'm playing with is cash. It's money. There's a lot of dry powder. Again, it's probably held by the top 10%, but it is what it is. When do they take it out of, money market accounts and put it to work on capital or investments? And the other thing I'm thinking about, Jonathan, is all of these companies that, and again, I'm not talking about the big boys. I'm talking about that next tier, small and medium-sized businesses who are frankly crushed and hurt by this rapid
Oh yeah.
increase in rates. They weren't able to buy capital equipment. They weren't able to expand. They weren't able to do anything. They were frankly batting down the hatches. Their cash flow statements went to crap. But the lower rates go, the easier it is to get a positive return on investments. And when does the small and medium sized business start to take on capital improvements? I don't know if it's yet, but Fed keeps
Uh,
cutting rates. It'll happen.
I think that'll be faster than people investing, right? Than the dry powder coming off the
Really?
sidelines.
Okay.
Well,
Oh, I
yeah, but
like that.
here's why I think that, because if they've been sitting there, like if there's pent up demand, they've been holding off on these purchases because the interest rates are too high,
Yep.
right? Or because they're getting crushed on their existing variable rate debt,
Mm-hmm.
right? Now suddenly, if rates for new purchases, like new financings, but also on their existing debt fall, then suddenly they're like, okay, now we've got the room to do it, right?
Yeah.
But for the investors, and especially if you what you point out is I think was a really important point. Let's assume that most of that dry powder, almost all that dry powder, is in the top 10%, right? I mean, a lot of those people have a lot of other money that's already working for them, right?
Correct.
It's not like they need to be earning money on that money to survive.
No, it's all
So
extra. Yeah.
it's all extra. It's all disposable, investable income, right? So if there's, as long as they remain, it comes down to a balance, right? If their fear is stronger than their greed, then they will
Mm,
sit on the sidelines no matter what, right? And
correct.
I still think that for real estate, all the news has been bad for
And
a
will
long
continue.
time now,
And
and will continue to be bad for
yeah.
some time. And so the fear will outweigh the greed,
Mm.
and that will depress investor interest,
I
right?
think
So
that's right. I think that's right. I think one of the things I've learned in history is bad news travels fast. So the
yeah,
people losing money today will tell 30 people and it'll spiral out. But the folks that go counter cyclical, which I've proven to do several times in this real estate journey in 25 years, I'm licking my chops. Because
oh
in
yeah,
video number 1, we talked about a building going from 100 to 70 million. I'd love to buy that building at 70 million and then,
yeah,
I get a loan for 54. It's going to be a beautiful thing.
yeah, absolutely. I mean, the people who have the cash, who are willing to, you know, who are willing to look at the data rather than give into their emotions, are going to do really, really well, and
Yeah.
always do in these situations. I mean, that's what the smart money is, right?
Yeah.
So those people will all do fine. But I think that there's a lot of people who are just, looking at bad news, and I think there are a lot of investors who sort of like flip from asset to asset to asset, right? And so whatever's hot, they go for. And I do think that there's a calculation with, say, the stock market or Bitcoin or something like that, that's much more liquid, where they're thinking, well, yeah, it's rising, I want to get in on it, and if it starts to fall, I can just get out, right?
Hmm.
Because they know that they can limit their losses.
Yeah.
Whereas real estate, like, once it starts sinking, like, you're in for the ride, and you just hope that, like, you know that there's not an event that causes you to have to realize the loss,
Yeah.
right? As long as you don't
Yeah.
have to realize the loss, you're fine. But
Yeah.
if there is a refinancing or something that has to take place and you have to
Yep.
realize the loss, that's when you're screwed.
That hurts. Yep.
But yeah, but I think people, you know, they're thinking more just about the illiquidity of it. I can't get out if I want to, and then, you know, so I think it makes them reluctant to
Yeah.
get in.
Well, folks, I'd be remiss if I didn't remind you, if you were part of my school community, One Rental at a Time, Jonathan did a market psychology presentation. I think it was about 4 or 5 months ago. You can find it in my school. Go to classroom, special guest, that thumbnail, special guest. And inside there, you will see a posting, Jonathan Twomley Market Cycle. I think it's about time we bring Jonathan back to our school. Maybe we'll set that up for next Thursday. Let you ask him some questions, do all that stuff. We'll make sure he's available next Thursday. But yeah, I think we got to start talking about all these things because there's a lot of opportunity coming.
Absolutely, absolutely.
Very cool. Well, Jonathan, where can people find you?
Yeah, well, as always, come and link with me on LinkedIn. And also, I do have my own school group. If you are interested in learning how to invest in multifamily, it is the Apartment Investors Club. But all you got to do is go to school.com/AIC, and you'll be able to find out all the details.
There you go. Jonathan, you're amazing. Thanks for everything.
Thank you.